Hi there everyone, and welcome to our third edition of On Track for the month ending April. So I'm recording this on May the 21st, so it's Tuesday, May the 21st, and obviously I waited a few days to record this one just to see which way the election went, and a good result for investors, which I'll talk about more. Just firstly, a quick warning: this presentation has been prepared for clients of McGregor Wealth Management. If you stumble across this and you're not a client, feel free to give us a call. But yeah, everything here is general, and as always, we'll talk about your own circumstances in your review meetings. And if you have any questions that arise from this, as always, feel free to pick up the phone or shoot us an email. So today I'm going to cover some of the important market news, put it all in context, update the key market areas and the portfolio results, and help to put it all in perspective. And by in perspective, I just mean, what does it mean to you? So the key news, obviously in Australia, election surprise for many, for most. The pollsters got it wrong completely. We always held some hope, and not so much, and I said this last time, not that I'm very political, but this was a bad tax proposition for anyone who was aspiring to financial independence. And as someone who's worked for clients for 20 years to help them achieve financial independence and maintain that, it was just a bad proposition. So the people voted, and they voted that out. So it's going to be interesting. It's a topic for another day on what's likely to happen, but it's on with good strategy, good management of your portfolios, and we lose a whole lot of distractions. So all the strategies we had ready to go, we don't need to use. We will talk more with you at your reviews about, as usual, any tax strategies and other things, but based on the existing rules. There's some really good budget changes and past budget changes that hadn't been legislated that we hope get legislated now, like 6-member self-managed super funds, contributions up to age 67, and we get to keep all the good things that are there at the moment. So very good for investors. Economically pretty boring, no change to interest rates by the RBA. They chose, as they often do, to leave rates alone in an election year. Remains to be seen whether they decide to cut in the coming months. Australia's growing slowly, 2.3%. That's kind of tepid. It's not too slow. We're unlikely to tip into a recession, although some people still predict that, as they always do. But we're growing slowly and boringly. That's not so bad, and it creates a climate where good companies can make money. Internationally, the trade war continues. It's bizarre to think that you can have a trade war via tweets with Donald Trump, and he seems ready for a fight with China. It's interesting, a lot of the Democrats secretly, or not secretly, some openly, are almost backing him on this one, because what the world's been wanting to do with China for a long time is get them to respect things like IP laws, copyright, trademarks, all those things, which they don't. So yeah, it's going to be interesting to watch. The market stopped reacting as badly. We did come down a little bit, which I'll talk about when I go through the market results. But the market sort of expects this to sort itself out. And yeah, it may do some damage in the short term. The US is already putting up tariffs on Chinese products, and they're retaliating in return. So yeah, it's going to be interesting to watch, but no real reason for concern for any portfolios. In the US, the Fed there is continuing to push the fact that rates are likely to stay low for longer, and US is growing well. It jumped from the previous quarter's results, which were showing annualized growth of in the low 2s, to about 3.2%, which shows an economy that's moving nicely, not over the top. And yeah, there's talk that there was talk of recession in the US based on a negative yield curve, but that's diminishing and doesn't look likely. All these things are always possible, of course. So let's have a look at different segments. Put that in context first. And it's interesting, I'll pause that Index chart, which you all see in our offices, the red and the blues across the top there, as I've been telling everyone for the last 6 months. The only 3 times we being the Aussie electorate, has handed government from the Conservatives to Labor has been Whitlam, Hawke and Rudd, and both were incredibly popular, and Shorten obviously wasn't. And I think that popularity plus his openness about what he was going to do has cost them the election quite clearly. Not by much, by the way, so quite a miracle by Morrison. Anyway, the context of the market, we have the market always being in one of these categories. FOMO, which is the boom, fear, which is the bust, and they don't happen very often, about once in every 17.5 years on average. Most of the time the market's in that wall of worry where it gravitates between expensive, fair and cheap depending on what's going on in the world, and what we talk about today will put all of that in context. Aussie shares up for the month of April 2.43%, up for the year 10.4%, so bang on pretty much the long-term average there. But a rocky road. The chart in the top right-hand corner shows the last year, so that dip right up to December are still quite pronounced, and you'll see a mini dip off to the right after the end of the month. In April, the markets came back a bit. They're on the way back up again when this was printed, but that shows you the difference in the response to the trade wars now. September through December, it was a deep response of 10 to 15% on the trade wars and fear of US slowdown. Slowdown turned out not to be the case, and people have lost that fear about the impact of the trade wars. The chart down the bottom shows the 10-year result, which is very typical of wall of worry, but note the starting point there below 4,000 was not long after the GFC, which bottomed in March 2009. So the long-term numbers there, so that 10-year number of 10%, which is bang on the average, is quite low considering that was from a market bottom. So we have a clear assessment for the Aussie market as being absolutely fair value, generally at around the ASX 200 of about 6,200. And give or take. It possibly got a little bit expensive, about 6,400. That's never a trigger to do anything radically with the portfolios, but it may be a time to top up reserves, or if you're withdrawing money from portfolios, those expensive times can be a better time to do that. So let's have a look at US shares, up for the month about 4.95%, about 20% for the year, so a great result. The chart I've got was done on the 20th of May, so it loses a bit of that year. But what's interesting, the blue line there is the US dollar. So 2/3 of the last year's return are because the Aussie dollar has dropped quite a bit. So it's come down to about 69 cents, which many economists say is about fair value at the moment. We tend to agree with that. And that's meant that US shares right at the moment are back at fair value. They were a fraction expensive, but they pulled back. They've come up again, but we still think we're in that fair value zone. US small cap shares, another great month for them, 4.82%. They've come back a lot in the last year, and you'll see the chart in the top right-hand corner. US small caps through the ETF IJR, which is that chart, which appears in our core portfolios and in our active portfolios. IJR has pretty much had a flat year from mid-May. Some dividends, but the year to the end of April was about 11%, but it had been running a lot higher than that, and even as we speak, the 10-year result from that is about 15%. Long-term, you would expect about 13% adjusted for today's inflation from US small caps as the heart of capitalism, where many of the great companies of the world emerge from, and they go through that space. So we're back in fair value there. So quite boringly for a lot of this stuff, but boring is good. Exciting life, boring money. Happy to be in the wall of worry at fair value. Global leaders, so as measured by IOO, which is the top 100 companies around the world, a good month, up 4.95%. And you'll see in the top right, all of these good months have been followed by a retraction, a little one, not quite as big as, nowhere near as big as the December one, and then a recovery. So we're looking at a flat month of May, even though we had a very good month in April. So yeah, global leaders, 1 year return about 17%. The 10-year, once again, from a low base, post the GFC about 11%. Long term, we would expect global leaders to be about inflation plus 7 or 8%, so about 10%. It's had a good run in the last year, but nothing to be concerned about, and certainly justified by continued good profit results for the most. And over time, these fair values go up as profit growth goes up. So they're not something that are stagnant. They'll go up by either good results being announced. Emerging markets are the ones that have suffered the most from the trade wars. Chinese market not so much, but other markets in particular. So up for the month 3%, so much better. But look at that 1 year result, just 1%, and that's purely because of the trade wars between the US and China. Now, very important to have that diversification. In the long run, emerging markets is one of those sectors that does grow above average, and which has done so. Even a 3-year return, they're still pretty good at 13.58%. Very important, as always, to have that diversification, so we're always picking up the good bits out of this and to have it in context. So what's that meant for the performances of the care portfolios? So for the core portfolios, you can see the results there. Good months across the board, with the balanced portfolio up 1.84%, the growth up 2.4%. So the numbers are looking good. If you look at the 1, 3 and the 5 year results, they're pretty much bang on line, particularly the 1 and the 5, with what we would assume for long-term returns. So about that 7% for balance. Call it inflation plus 5. We're sitting at about 2% inflation in Australia. And the care the care portfolios down the bottom include the active portfolio and include the enhanced portfolios. So they're somewhat higher. So they're doing really well. They're literally sitting in the top 10% of their peer group and above their benchmark, which is the indexes. And it's quite ironic that the more active managers are doing way below their peer groups. So a good result. As always, that will vary over time, but nice to see those numbers printing consistently, particularly in that 3 to 5 year range. So let's have a look at the property market and some information here from our friends at CoreLogic. You'll see the reference at the top of the screen there. Write that down if you want to read this full report. If you'd like to see what's going on in the property market, it's a free report available from CoreLogic. But it's basically showing that returns are negative for the most part of Australia at the moment, with exceptions of Brisbane, Adelaide, and Hobart, and Canberra. Everywhere else is down. So they do put a combined average there. The combined averages for the country are not really worth much, because the property market is not so much one property market as a whole bunch of markets. And the correction predominantly in Sydney and Melbourne, but also in Perth, is one that was necessary, particularly in Sydney and Melbourne, because they had such a great run. The election no doubt is going to put a floor under property. We've seen anecdotally a lot of new clients and others say they just want to wait and see what happens with the election. A bit nervous about impact that might have had on property, and then we take out that threat to negative gearing and other threats like the removal of the limited recourse borrowing arrangements, and that means the property market should be unaffected, and it will leave it to the good old laws of supply and demand to determine its direction. Just a reminder, as always, how far we've come. 2003, look at those prices compared to the median prices there. So up substantially, as you would expect in a country that's growing in population and is growing in affluence. From our friends at Heron Todd White, and you can find this report if you Google it as well. It's a detailed report. In this update, I just put in the property clock, and it shows, as always, where it thinks different cities and regions are in the property clock. So once again, Sydney, Melbourne, at that 3 o'clock point in the declining market. They may reach a bottom in the coming months to year. Interestingly, Brisbane and bits of southeast Queensland and other regional areas, there's always somewhere to buy a property for those that are in the market for investment property, and certainly the areas that we're comfortable with at the moment include places like Brisbane, southeast Queensland and the Sunshine Coast. For units, much the same story, some slight differences there, but not much. And certainly, once again, it shows the fallacy of the press talking about one property market. There are multiple property markets, and there's always someone worth buying. And even within those sub-markets, there are still properties worth buying. I know of some of our clients that are actively looking for properties in Melbourne and Sydney for their homes, and they're comfortably, and they're in a market where they're selling theirs and buying, so it's nice to be in a market that's down a bit as well. let's put all that in perspective, and as you'd expect, pretty boring, everything in sort of normal conditions. So what do the conditions mean to you? Pretty much steady as she goes, stick to the plan, rebalance where you're necessary. It's a good time to be buying, and it's a reasonable time to be buying, and it's a reasonable time to be selling. It doesn't mean it's the best time to buy or sell, and as always, that's why we'll often delay buying or selling until we reach a time that's better. But we don't mess with the portfolio as we go through the normal wall of worry, except to top up the reserves so that we've always got funds there to pay out pensions. Continue to review, as always, which we'll do when we sit down with you. And put all this into practice with your own portfolios. So a fascinating month, market steady for Australian investors, a good election result. I think there's still a clear message to the coalition. They've got to get their act together, particularly around the environment and a few other issues, but we should see a steady term now with one leader, which will be kind of nice to see. Just want to reinforce our process. As always, goals first, based on what's important to you. Every plan, that's the underpinning. The portfolio designed to meet the goals. We always take a long-term view, but with the medium-term adjustments based on the type of things we've talked about today. Massive diversification means no one issue, no one investment, no one sector will ever cause us any grief. And low-cost index funds for most growth markets means we're getting results way above the average for active investors, and protect against that short-term volatility through reserves and dollar cost averaging. Thank you again for your time. I look forward to seeing you next time I see you, and I'll talk to you next month.